Okay, good afternoon again. Second afternoon making videos to promote Kahn Capital, help us to really launch and give the first big steps, okay? This video today is gonna be short one, but I really recommend you to go and watch our 20 minutes presentation, the 24 minutes presentation, okay? That's the best way to know what we do and who we are and how good we are and why we make money and why we will make you money, which I guess is more important. If it isn't already fascinating the fact that we do money. And we had an interesting conversation in that 24 minutes presentation, which I think is going to give us a very good way of talking about the subject that is important, which is other hedge funds and how they operate compared to Kahn Capital. And we were mentioning about the possibility of connecting you with other hedge funds, which I think is something valuable and is a good idea to add to our catalog of valuable things to offer. So we will talk a little bit about that today. But first, a disclaimer. First, we have to inform you, the news. Here in Kahn Capital, we have decided to become extremely exclusive. We have changed our policy of acceptance, and basically, if you don't have $1 million cash in the bank minimum or more than that, we have decided that we don't want to do business with you, and that we cannot accept you as a client. Then a second thing, if you're under that amount, we have a second requirement, which is that if you haven't read my book, which is 169 pages more or less, you won't be able to get accepted at Kahn Capital. Like now, a requirement to become a client is to have read my book, and yeah, basically that's it. Here we are, like starting a movement, religion, and our book, our Bible is this. And if you haven't read it, you cannot be included. I'm sorry, and I was joking, of course. I'm just joking with you, but. The important things to learn is that other hedge funds, they behave in that way. They are very exclusive, and you really don't want to get in, or you won't be able to get in. You have a world of different funds out there. You have to understand. Like if you read my book, I state there, there might be more than 25 different approaches to the markets, and different stocks you can invest, or different industries you can like, or how you mix them with real estate, or mixing with angel investing. Perhaps you allocate 10% of your portfolio in angel investing, and you do great in that 10%. There's so many things you can do in the world of investing. It's so rich and diverse, and out there you can find so many things. And you have to be aware of that. You have to be aware of that, and that multiple people will have good returns. And but the thing I wanted to underline, because we were comparing Kahn Capital with other funds, first thing I told you is that what makes a partnership extremely valuable is when you remember that I told you there's multiple ways to the top of the mountain. I told you that for some hedge funds, their mountain is a big one and high one, representing them being in business for 30, 40 years. And then I explained to you that other hedge funds, they're in business for 10, 12 years. They just want to make a lot of money, and then they are done. And the problem with those hedge funds is that usually the smaller mountain, and this is the top, as I told you. And then I told you there's multiple paths to the top of the mountain. That's a Chinese proverb. Samurais also like to say it a lot. I guess some writers, some samurai writers, I don't know if samurais back then they really went into that wisdom. But the message is there's multiple paths. Some people investing in tech stocks only go here. Then we have all us that we are going to do value investing with the ups and downs and everything. And then you have other people that love real estate, and they are more slow, and they go like this, and then they're slow, but they reach the top of the mountain. You have so many different paths. And the message is, The problem with hedge funds, when the mountain is a small one, when they want to stay in business for 15 years, is that they have no issue in selling you a lie, in selling you an investment strategy that is not going to last. Imagine back in the day when all the dot-com bubble was going on and all these tech companies were emerging. Back in those days, many investment funds that have like a sex appeal for I mean the opposite. Like they had an attraction towards investing in tech stocks, and those stocks weren't the most undervalued out there in matters of value, common stock equity and things like that. But they were going to do great because we have the boom right now of tech stocks and so on. So they did that kind of investment and they did well. They did great. Then they start developing a reputation. Then after 10 years of doing great, they start being known for that and so on. But the thing is that sometimes those strategies will expire. That's the thing. Some strategies in hedge funds and investment funds are going to expire. And the problem is that those funds don't have the flexibility to switch into a different strategy when those strategies expire. And that's the thing. You can invest in these guys that want to be in business for 15 years and invest in a specific business. You lose margin of safety because they are investing in things that are overvalued. And then if you are lucky, you are in a moment where those type of assets are going to do great, and you will do great with them in that fund. However, they are not in the long term. Myself, I thought a strategy that's going to work 40 years from now, 50 years from now, 60 years from now, which has existed since the beginning of history, human history, and perhaps the beginning of capitalism, which is a huge and diverse world where there's so many different opportunities and human beings that cannot focus on all of those opportunities. Now the public markets are crazy. You have no idea. We have more than 30,000 interesting securities to look at. Much more than that. If you open the Bloomberg terminal and you watch how many stocks are out there, or even myself when I see all the stocks that I look at because they have the criteria I'm looking for, I have thousands of securities to look at. Okay? And the thing is that the strategy I developed is made for a huge amount of time. Perhaps we are lower return, but we are higher margin of safety. That's the priority of this fund, and perhaps in the future, just for fun, I will try to create a fund that in 10 years is going to close, and I will try to put inside that fund a strategy that's perfect for this time and will adjust perfectly to everything, and in 10 years we will make a lot of money. Okay, but I don't like to do that. I like to sell value. I like the things that are undervalued. I like margin of safety. I love that I can put the money in my strategy and sleep at night because I know it isn't something that is based on feelings and things that have to happen in the future. It's based on things that are happening already now in value that the business already has right now. And then if I can combine that with great earnings, I do it. If I can combine with great margins of profit margins, I will do that. If I can combine that with a company that's more like technological and really can become very creative, I do that. Actually, one stock in my portfolio has that. I didn't bought them because of that. I bought them because they were extremely undervalued. They have more cash in the business than the market cap of the entire company. Okay, they don't need funding because they already get funding by themselves. Okay, sometimes they go for funding because they want to grow faster. Okay, but they are technological. Perhaps they will come with some great ideas. However, I understand that Amazon or Google has a team of geniuses and programmers working to create the last thing. However, I never will invest in those businesses because they are extremely overvalued. If they don't deliver what is being expected for them, it's going to be a tragedy for investors. When those companies that have a PE of 30 and 40 by any chance don't deliver what they should deliver, and the price corrects to 20p, 10p, or a more reasonable 5p, which means in 5 years I will produce enough money to pay you back. Less years because sometimes profits increase and so on. But what I'm saying is that when the PE corrects, it's going to be a tragedy. And yes, those funds worked very well. And they invested in tech stocks and they did great and so on. That exists. What I'm trying to tell you is that our mountain is higher margin of safety and everything. What's the value of this? If you are interested in finding other hedge funds, as I explained you in the previous presentation, no problem. Go ahead and do it. You can do that. We can negotiate, as I told you in the previous video, a percentage, which I know is capital that's going to stay in the business, for sure in the long term, which is something I'm interested in, so I can show you how powerful my strategy is. But also, if you want to allocate your money in other hedge funds and diversify that way, I can help you and give you a second opinion about them and tell you if their strategy is already expired. I can judge if they want to stay in business for a long time or for a short period of time, and then help you out with that if that's your purpose. But my responsibility in that case, and I'm doing this in advance because right now the only thing I'm selling is investing and cash out the profits. That's it. But if I want to really get into this additional service, my responsibility will be to tell you this is a fund with a strategy that's going to expire. Check it out. Or I will be saying to you, I like these guys. These guys are like Warren Buffett. They do value investing. They really have a strategy in place which is going to last. It's going to last. It's something designed to last for 60 years. The boom of tech companies, that can disappear. What it cannot disappear is people being inefficient, markets being inefficient. If we go to the books, we call it market inefficiencies. That's not going to disappear. Okay? And yeah, that's it. That's basically it. I don't want to make this video too long. This is going to be designed in a way where people that have lower tolerance to videos can really get to know a little bit about us and about Kahn Capital and what we offer. However, my advice is that this is a short video. I just made jokes, explain you a little bit of this and that. Do not take a decision based on this video. Go ahead and watch the longer one so you really can get more information and do more due diligence and all of that. Yeah. So thank you for watching, and hope to receive a call, email. You have all of that around the website. Thank you for visiting us, and I hope I gave you a lot of value. And if you already tried my book, I hope it really helped you to manage your finances alone, without help of anybody, because value investing is something that's very manageable for people that's very busy with other professions and other projects they have, or passions, or whatever they have. This is something that's extremely manageable. So if you read my book, I really hope it helped you to invest by yourself. If you still don't have the courage or the connections or the money or the attitude necessary to get into partnerships and get the help of other individuals to grow your money and all of that. So thank you very much for watching, and I wish you all the best as always, okay? Many blessings. Goodbye.